Welcome to the first quarter 2018 quarterly market update and portfolio update for Nepsis. My name is Mark Pearson, Chief Investment Officer of Nepsis. Thanks for taking the time to be on our call. Most importantly, thank you for the opportunity to be a steward of your resources. We're going to just give some brief highlights of the last quarter, what we see happening with markets as well as with portfolios, and of course we encourage you to take a look at the hard document that we will send you on the quarterly along with this video. First of all, I want to thank you from myself and my team for the patience and the work that has been done to transition Nepsis from TD Ameritrade to Trust Company of America. As many of you know, we made a very important strategic decision at the end of last year to end our relationship of 11 years with TD Ameritrade and move client assets to TCA. Obviously, anytime there's change, people want to ask why. People ask, why do I got to do all this work? What's the purpose? And certainly here at Nepsis, it's been a major change. It's been a major move for us, but the bottom line and the most important thing we want our clients to know, that we believe that this decision is in the best interest of our clients. And we believe that by having a partnership with now TCA/E-Trade, that as we look over the next 5, 10, 15 years in working with our clients, that it is not only in Nepsis's best interest, but more importantly, frankly, in our clients' best interest to work with a firm like TCA E-Trade in providing high quality service, high quality information and technology to help our clients continue to accomplish their long-term investment and planning goals. So thank you for your attention to the detail, attention to the matter. We're extremely grateful and extremely blessed that you continue to work with Nepsis, and we look forward to continuing helping you accomplish your investment and planning needs. Some have asked about why the name change. For those of you who don't know, we changed our name at the end of the year while we made the transition to TCA from Nepsis Capital Management to Nepsis Inc. For those of you who don't know, Nepsis is a Greek word which means to be watchful, alert, and vigilant with a clear and sober mind against illusions and fear, thus allowing one to obtain ultimate clarity. And as we moved through the transition from TD to TCA, it was done strategically at the same time with the name change, as well as rolling out new communications, new content to help our clients better understand, hopefully better understand, Nepsis and how we continually manage and oversee your assets here at Nepsis. By taking the capital management out of Nepsis, what it allows us to do, what it allows us to tell you as our clients, is that we're more than just capital management. We work with financial advisors all over the country, and certainly your assets being overseen, being managed is very important. Asset management is just one component of many to help you not only accomplish your investment goals, but also accomplish your planning goals. Because at the end of the day, we want to answer two questions. Are my investments doing the best they can? And am I on track to have the kind of financial future I want to have? By taking the capital management out of the name and going strictly to Nepsis, what we really believe we're doing here is helping us identify with you the foundational core of your success in planning and investing, and that is Nepsis, ultimate clarity. So we're excited about it. As you may or may not know, we have unloaded, I don't know, I think we're up to 10 podcasts now. We are going to continue to add podcasts. I'd encourage you to go to investwithclarity.com, our new URL for the website. Again, instilling clarity. Well, what is the clarity? What is Nepsis? Besides being ultimate clarity, we really believe in the investment world that Nepsis is know what you own and why you own it. So as we put out our first quarterly update with the name change, I want to encourage you to take a look at our podcast. You can go to Podbean, you can go to iTunes, you can download the Invest with Clarity by Mark Pearson podcast and listen to a host of different conversational pieces that get into the detail of the who, what, where, when, why, and how of the decisions that are being made with your money, i.e., know what you own and why you own it. Now, let's be blunt, for many of you, you probably don't care what you own and why you own it. And that's fine. But our experience has been over 20 years in managing money for investors that most people don't care what they own and why they own it until they care what they own and why they own it. That usually happens with increased market volatility. Hence the title of our new quarterly update, Welcome Back Volatility. And let me be the first to explain, if you're a long-term investor, if your assets are allocated in the manner that is according to your investment objectives and your tolerance for risk, we love volatility. While most investors worry about their investments, while most investors try to prognosticate, postulate, and speculate about what markets are going to do, we continue to tell our clients, like yourself, you don't invest in markets. You invest in businesses. The markets are only the greatest tool ever created to bring buyers and sellers of businesses together. Feel blessed, feel grateful that we have a market, that we have a process where we are able to strategically cost average, continually invest in great businesses over time. And we're going to talk specifically today about two businesses that you own, or most of you own, or will eventually own in your portfolios. Now, volatility is back. But I've spent a lot of time talking about this on our radio show on Investing for Success. If you have not seen the radio show or listened to it, we, in this past quarter, started doing our radio show that is actually broadcast here in Minneapolis on AM radio as well as on iHeartRadio. We have also started doing the video live. So we record our radio shows on Facebook Live. So you can go to the Nepsis Inc. Facebook page. You can find our old shows. You can watch our show live, where we do our live radio show talking about portfolios, talking about investment decisions, talking about the markets, and various other things. We try to keep it a little bit entertaining while at the same time keeping it educational, because if you're like me, I think a lot of financial programs are boring. So we want to make it fun. We want to make it entertaining to help you get an understanding of what's happening with your money and why it's happening in the first place. So that brings me to asset allocation versus diversification. I've written about this before. We talk about it a lot. And as we're in a world of greater volatility, what's most important is understanding the power behind how your dollars are allocated to accomplish your goals. Many investors tell us that during volatile periods, they will make the statement, well, gee, I thought my portfolio was diversified. I thought my portfolio had lots of different investments in it. And that may be true. In fact, at the top of the market in March of 2000, before we went into the long bear market, many investors came to our office saying, you know, we thought we were diversified. Folks, let me explain something to you bluntly, and this is what you need to understand about how Nepsis manages money. You may be diversified, but diversification is only one aspect of the investment process. Asset allocation is equally important. So what's the difference between diversification and asset allocation? Diversification is I own lots of investments in the same asset class. Asset allocation is I'm diversified, but I also own assets in different asset classes. Small cap stocks, mid cap stocks, large cap stocks, growth stocks, value stocks, international, emerging market, gold, bonds, cash, real estate, even private investments. Maybe you may want to invest in art, you want to invest in wine, you want to invest in stamps. At the end of the day, that is asset allocation. Owning investments from different asset classes. Don't misconstrue that with diversification. Here at Nepsis, our investment story, our investment process is global asset allocation strategy. Please don't ask your financial advisor why your portfolio is not doing as well as the Dow or the S&P 500. We are not an index fund. We invest in great businesses and continually invest in those businesses over time, not just in the United States, but internationally as well as in the emerging markets. We are what's called unconstrained. We may hedge at different times, but I will make you this promise. Every single position that we own in our client's portfolio is owned for a very specific reason to accomplish the long-term investment goals as based upon your investment policy statement, your IPS. We are one of the few firms I'm aware of that provides a highly detailed investment policy statement to help our investors understand what the expectations are for the portfolio. The irony is that we've been managing money for a long time, and we've had great success over the years. And in 2017, although our clients made money, they did not make money based on historical performance relative to lots of different markets and indexes. This, of course, had to do with one position we own called Zest. Not going to spend a lot of time on this. I will only say this. If I'm continuing to invest in that company in your portfolio, you need to understand that based on the information I am getting, I believe that based on Nepsis's buy discipline and sell discipline and the asset allocation strategy of your portfolio, we will continue to strategically cost average in that company over the long haul as long as our criteria is continued to be met. We've had lots of people ask questions, lots of people asking why the stock is doing this or that. Is the company going to be viable? Based on the information I know, based on people I talk to, remember I've been involved in this company for many years, I will tell you this. I am more bullish about the future of Zest than I've ever been in the past. It doesn't matter, folks, not only with Zest stock price, but any stock price. It is a snapshot in time. If you're invested in a great business over time, what your statement says about the value of your portfolio or the value of any position in your portfolio, bluntly and frankly, is irrelevant. It is irrelevant because, folks, you don't make or lose money until you sell an investment. That is the bottom line. Now, know what you own and why you own it. Nepsis. One of the things we're going to start this quarter is featuring and highlighting a company we own. While Zest has been a poor performer for us, one of the companies in our clients' portfolios called NVIDIA was the #1 best performing stock in the S&P 500 last year. Most people don't pay attention to that because they're so myopically focused on things that are negative. Think about your portfolio as a process over time. Investing is a process over time. NVIDIA, we started investing in almost 2 years ago, starting around $61 a share, now about $230 a share, the #1 best performing company in the S&P 500 last year. NVIDIA is a semiconductor company that is shooting on all cylinders. Connie on our investment committee has put together a commentary. Won't go into all that detail now, but it'll be in our hard copy that you'll be able to take a look at why we invest in NVIDIA, why NVIDIA is a great investment over time. Again, know what you own and why you own it, but at the same time, it's just one position in a well-diversified and asset-allocated portfolio. All right, now, fixed income. Whether you know it or not, you may have experienced or seen interest rates continue to move higher. This should be no surprise for our clients. We have been writing about this since 2013. A long-term investment thesis that interest rates will move higher. We have communicated often about the advantages and disadvantages, and the idea that owning bonds is more of a function of reducing volatility in the portfolio. But I'm the first guy to tell you here right now, I'm not a fan of bonds. I would rather own cash, look for pullbacks in dividends to buy more in those dividends, because dividend stocks have pricing power. They can raise prices over time as the cost of doing business, as interest rates move higher. When you lock yourself into a bond, you are stuck at that interest rate until the duration. And most investors do not understand fundamentally not only the price risk of owning fixed income, but the purchasing power risk. In other words, if I buy a bond at 2%, 2.5%, but inflation continues to rise over time and the cost of buying goods and services goes up over time, hey, it's great you're getting that 2.5%. But what's more important than the value of your portfolio at the end of each month, folks, is your purchasing power. Your ability to take the dollars you have to purchase what your needs and wants are. We continue to believe that interest rates are going to move higher. There's a lot of chatter that that's going to have a short-term impact on the markets, the economy. Maybe, maybe not. I have a news flash for you. This is not the first time we've seen rising interest rates. Don't sit there looking at the TV and listen to all the noise and people prognosticating, postulating, and speculating. Stick to the knitting. Stick to the investment process. Stick to the idea that long-term successful investing is about sticking to an investment process. It is about investing in great businesses over time, using volatility to your favor to take advantage of buying things on sale, while at the same time having an appropriate asset allocation strategy that is conducive to your investment goals and objectives. Thanks for tuning into our update. We'll talk to you next quarter. Have a great day.